Well, hey there, everyone. Happy Friday. We made it to the end of the week, Friday, February 20th. I'm your host, Dave Keller, and welcome to Chart This with Dave Keller. We're coming to you from a beautifully overcast winter day here in Redmond, Washington. The air is crisp. The ground is kind of frozen. It's a beautiful place to be, and I hope you guys are doing well and staying safe wherever you're tuning in from. It's been an interesting week, a choppy day with news about the Trump tariffs being rejected by the Supreme Court, causing some volatility. But by the end of the day, and economic data coming out earlier in the day as well. End of the day, though, the S&P finishes near the highs of the day. The S&P closing above 6,900. It looks like our short-term market trend model will turn back positive as of today's close. So a lot of things to keep in mind. Today on Friday, we're doing an all mailbag episode, so we're going to share with you some initial takeaways from our review of market conditions here. Then we're going to get right into some of the fantastic questions you guys have been asking this week. All of the questions I'm about to share with you have come from viewers like you, putting a comment on our YouTube channel and sharing a question, so please keep them coming. It's always great to hear from you. And let's just talk about the markets here pretty quickly. So the S&P closing near the highs of the day. That's good enough for the S&P to be up 0.7%. The NASDAQ a little bit better, up 0.9%. Mid caps and small caps all good. The VIX getting back above 20. Thursday we closed above 20. Today we're back below there. So the volatility of the volatility remains fairly high, I would say. Bonds sold off today. The dollar was flat. Commodities generally higher, with silver prices accelerating big time. That's one of the big takeaways today. The SLV was up almost 8%. Crude oil was down, and energy had a pretty rough day. Cryptocurrencies trying to find their footing. Bitcoin currently just trading below 68,000, but all of the top 10 coins in the green. Communication services and consumer discretionary, the best performing sectors. Only two were in the red today, energy and healthcare. The breadth was pretty decent, right? I mean, generally pretty good. 2-to-1 ratio of stocks up versus down. And I think the most important takeaways, besides what I've mentioned so far, strength in commodities come to mind. Some of the mega cap growth stocks doing quite well. And this, I think this particular event on Friday here kind of saving this week for the benchmarks. Big moves higher in Alphabet, Amazon, Netflix, all up over 2%. Alphabet was up over 4% at the close. That's enough to really drag our benchmarks to the upside. Noting at the bottom, though, Microsoft down on the day, Broadcom down on the day, and those charts continue to be pretty underwhelming. The S&P, though, again, remains literally in a consolidation. We're currently right around 6,900. We reached 6,900 for the first time the last week in October, and all of this choppiness around 6,800 up to 7,000 over the last couple months has gotten us nowhere on a directional basis. Even though breadth remains strong, even though plenty of individual stocks are doing quite well, our benchmarks are sideways. That is going to be the environment I think we're struggling with for a little bit here. I do want to give up one other quick note, and then the remainder of my awesome thoughts will be reserved for my Market Misbehavior Premium members. I'm going to be getting ready to get the weekly flight plan going here a little later today. By the way, always a good time to be a premium member. A lot of great benefits, including access to our virtual courses, our member-only reports like our weekly flight plan. I see that as our most important work every week. Also, our monthly chart review. Also, immediate and full access to our member community. All a lot of fun. You can find out more information at marketmisbehavior.com/premium. And if you check that out, make sure you use the code YouTube for a special deal on your first 12 months on any plan. Marketmisbehavior.com/premium. That's where mindful investors go. By the way, one of the stocks we talked about this week was EXR, Extra Space. And I'm going to do it on an unadjusted basis just so we can see this little breakout here, right? It's sort of a cup and handle pattern with EXR. Peak in October, peak in January, kind of sloping downwards. Earlier this week, we kind of pushed up to that same level. Today, looks like we're finishing the week in a position of strength, completing that cup and handle pattern, implying much further upside from here. I like that breakout. Want to see it, really continue above 153 and clear this level of resistance, which goes all the way back to May, right? 10 months ago, 9 months ago. We're still trying to get above that resistance, but pretty close to a breakout. We talked about that stock as, encouraging that it's above the 200-day. Well, let's try to get above some of these previous highs. Actually, looks like it's starting to play out there. It's a REIT. That's in the real estate sector. All right, let's get to some of the questions here. As a reminder, these all came from people like you. Please follow their awesome example and drop a comment on our YouTube channel with your own question. Maybe we'll answer it on our next mailbag episode. Question number 1, Dave, when you see a stock in an uptrend, what is the process afterwards? For example, Caterpillar in a strong uptrend, how would you approach it to open a position? Really good question. And I would say this, right? So I'll tell you this, right? When the point of this show is obviously not to make recommendations. The point of the show is not to tell you, hey, everybody, go right now real quick and buy Caterpillar. You'll never hear me say something like that because I don't see that as my role. I think you need to make your own decisions or consult with a financial professional. I'm not licensed to be giving you formal recommendations. What I am trying to do is give you the tools and techniques that you need to make better decisions. My goal is to take investors making poor decisions, making mindless decisions, and help them make more effective, more well-informed, more mindful decisions with their well-earned money and help them to grow their capital in an appropriate way. So in light of that, right, how would I approach this? I'm happy to share with you how I would approach a chart like Caterpillar. So first off, I would say, listen, I think people often get way too nervous about buying stocks in uptrends because there's always this fear that you're going to top tick the chart, right? You're afraid that if you buy Caterpillar today, that's going to be the high. You will be the last person that buys it, and then no one else is going to ever want Caterpillar again, and it's going to go lower. And just looking at the chart of Caterpillar for the last year and a half, there are a number of times, like September of 2024, when it's making a new 52-week high, we could say, wow, this feels really rich at 450. It's almost doubled from that moment. We can see similar breakouts in November, in January, where we've broken above previous resistance. So I would say, number one, looking for a break above resistance, a break above the base is usually a good place to start, right? Those would be like the most actionable ideas. And that's why I would argue that's why you don't just look for Caterpillar kind of charts that are in these long-term uptrends. I'm trying to find stocks just starting to emerge from a base or above resistance. That's why I look for stocks making new 3-month highs to capture this kind of chart where it breaks out and you go, ooh, Caterpillar's been sideways for 8 weeks and now it's starting to break out again. That might be an encouraging or an interesting time to take a bit of a nibble. You'll find a lot of times, like we saw here in January, right? We break above resistance, the resistance becomes support, and that's around 625, that peak in December and that low in January. So, paying attention to those levels can be pretty meaningful. So what do you do in this environment? I would say 2 general ways you can play something like this. Number one, you just buy the stock that's in a strong position and use stops in case you're wrong, right? So buy the uptrend. Don't worry too much about your entry point. Just make sure that you focus on having an appropriate exit point, right? Because the worry is you buy here and it just starts breaking down. So right as you put the buy order in, think about what that stop order needs to look like, right? Is it a test of the 21-day EMA? Is it a break of the 50-day EMA? Well, whatever makes sense to you in terms of how much pain you're willing to accept for the opportunity to ride the next leg higher. Because the reality is we definitely can chop around even within a healthy uptrend, right? We don't want to be scared out of Caterpillar because these kind of sideways moves. So scenario number one, I guess option one is you just accumulate the position and then you use a good stop. Option two is you wait for a pullback. And the benefits of that is you are not buying a stock making new highs. You're not buying a stock going vertical. You're buying when there's some short-term weakness, right? Kind of looking for this kind of opportunity for the, buying in on short-term weakness. The risk is there's never a meaningful pullback. And that's why that strategy has its own, downfall, right? Because let's say we were waiting for a pullback, the pullback never comes and we just keep going higher and higher. That's happened a number of times on charts like Palantir, right? There just never feels like a good pullback. And so you never really get that opportunity. So we can't have it both ways, right? We can't have the perfect entry point, but not get, but always make sure, but always be certain that we're going to have a pullback. It just might not come. So in reality, I kind of do a little of both, right? And by analyzing the chart for me, would I buy Caterpillar today? I probably would wait and I would probably be waiting for some sort of an actionable pullback. I might take a nibble when it pulls back to the 21-day EMA, for example. That would be a reasonable pullback within an uptrend. If we got down to the 50-day, I would probably be very comfortable taking an initial position because we've had a bunch of pullbacks to the 50-day on the way up. And the good news about buying a pullback to the 50-day is it's pretty easy to set a stop just a little bit below the 50-day. And if you're wrong, and if that wasn't a buyable dip, and if sellers just keep pushing it lower, then you get out and you minimize your losses. So that's how I would tend to think of it. Think of different time frames. Buying a stock that's accelerating can be very challenging. Waiting for a pullback, means you have to have patience, but often will give you a better opportunity, a better entry point, which is what we talk about. So my standard goal is to buy things in good uptrends that have pulled back. So strong for the last 12 months, weak for the last couple weeks. That would be my ideal scenario. So Caterpillar on a pullback. That's what I would often say with portfolio managers that I would be working with in an institutional capacity. Great chart. Buy the pullbacks, right? That's the opportunity. Buy short-term weakness within a long-term uptrend. Those are some of the technical tools that I would use. There are many others, and maybe the subject of a video down the road to talk in a little more detail about those strategies. Number two, were there any instances where the Hindenburg Omen doesn't work? For example, the market does not drop upon the signal. Yeah, there are. And again, it's so funny. I mean, I've been doing this for a little while now. And anytime I talk about some technique, it makes me laugh so much, and I appreciate it because it comes from a good place. But I'll have people will say, "Well, it didn't work here." Nothing works all the time. Anyone that tells you they're using a financial approach of any sort and they imply anything about it's close to anywhere near close to 100% accurate, like they're lying. Like it's just not true. So things like that don't exist. The reality of investing is you're wrong a lot. You're wrong a lot more than you want. You don't get an A. You're not right 90% of the time. You rarely are going to be. Hopefully you're right more than you're not. But even if you're wrong more than you're right, but you have good money management skills, you can still have great performance because you're minimizing your losses and maximizing your gains. So, too often I think people, you can't dismiss an entire approach because it was wrong once. That just means it was wrong once, which means at least it's honest, right? So that's good. Here's my Hindenburg Omen chart. It's going to look kind of ugly, but I'm going to go like 25 years back. So I apologize. This is not the most pretty chart I'm ever going to show you, but it is answering your question. So this noisy sort of pink series at the bottom, I could probably do 20 years because that first 5 years really didn't have much. These clusters of signals are when the Hindenburg Omen has fire, right? So remember, the whole point is you need multiple signals within 1 month of each other, and otherwise it's not a valid signal. So these kind of weird, awkward bars do represent times down here where we have had valid signals, and you can see I created this exact chart back in 2017 because you can see that's when I started making these little. I think I had a different chart I was using before then to track these inputs. So you had signals in like 2013, right? Didn't really play out, right? 2013, 2014 were remarkably strong years. You had a Hindenburg Omen at the end of 2014, and then it was 6 months before any sort of drop. It's certainly not 100% accurate, and I would say it's rare in my experience using this indicator. It's rare that you would have a major market top where the Hindenburg Omen does not fire. And the last time that's happened, just glancing at the chart, is like the 2011 peak, right? You had some signals back here, like in 2010, but 2011, we peaked here in the second quarter. Then we had a decent drawdown into an October low. Hindenburg Omen was quiet because you never really had enough new lows in that period to trigger the signal. But that's incredibly rare, right? I mean, most major tops, the Hindenburg Omen will fire. So that issue I don't see happen very often. Does the Hindenburg Omen fire? And this is your question. Do you get signals that don't end up resulting in a downtrend? Absolutely. And that is, more recently, right? And when we saw that just with the most recent work of the Hindenburg Omen, right? We had this signal in November. We haven't sold off, right, in a couple months after that. So you'd probably consider that a failed signal and that we've continued to go higher. Now, I would argue the market's been basically sideways from that point So I still think of it as pretty decent, but if you're kind of doing a back test, you'd probably say that wasn't a great signal. This one in December of 2024, was that a good signal? It was 2 months early. I would say yes, because it picked up on those conditions going into it. So how to think about that? So the way that I talk about the Hindenburg Omen and the way that I share about it on this channel, especially with the cluster we've had again recently, the Hindenburg Omen on its own is not a reason, in my opinion, to get super defensive or to be selling aggressively. And you can see that just here, right? There's no guarantee of a peak after that signal. It does tell me to be focused on the line in the sand because the conditions are similar to previous peaks. So now all I want to do is confirm that a top has happened. So look for signs in terms of price deterioration, momentum deterioration, breadth deterioration, spike in credit spread, spike in volatility, all those kind of classic topping patterns. For me, the Hindenburg Omen tells me to dust off the market top checklist and start reviewing the conditions to start checking them off if they arrive. That's how I have made the Hindenburg Omen much more consistently helpful, because the Hindenburg Omen on its own isn't enough. That for me isn't enough to be bearish. It tells me, wow, we're looking very similar to previous tops. Now I need to apply the stuff I always apply to market tops to see if those boxes are checked, because those are the things that have helped me confirm, yep, that's a significant peak. I need to get out of the way. We just didn't see those in the fourth quarter of last year. The S&P held 6,500 pretty well in November before rallying to make a new high into the new year. So yes, the short answer is yes, there are instances where it doesn't work and the market doesn't drop. That's why the Hindenburg Omen is not a standalone indicator in my opinion. It's like a siren that goes off, and then you have to monitor the evidence to see if it follows through. Next question, could you explain the role the technical analysis toolkit plays in accumulating index ETFs over the long term for bogleheads with a 10 to 25 year horizon? I don't get a lot of questions from self-proclaimed bogleheads because my work tends to attract people who are more actively managing their assets, right? They're sort of, the bogle approach is basically put money in an index fund and don't pay attention to the market. There's no benefit, right? You just want to just keep dollar cost averaging, putting money in there, and time is going to be your best friend, right? And the runway you have ahead of you, it's what's going to help the most. And listen, as much as you may or may not agree with Bogle, him and his work has inspired a whole generation of investors to put money in the markets, a lot into ETFs, of course, and index funds. And I don't think that's a bad thing. I think that's good for people generally who don't have time to focus on it. The question is there an opportunity to do better than average if you have better decision making? And I would argue, yes, there is an opportunity for that. There are plenty of people, from professional money managers to individual investors, that don't do a very good job of it. I would humbly suggest they need more charts in their process and more consistency. And there are plenty of people making bad decisions. So looking at average returns from investors just shows you that the average investor doesn't really know what they're doing well enough. Hopefully you people watching are not in that cohort and we're able to make better decisions. So to your point, what's the role of the technical analysis toolkit? So if you think of the Bogle methodology as one side, it's like a very passive, I'm just going to put money in an account and not think about another moment. And then on the other hand, you have like an aggressive, active trader, a day trader or a swing trader, position trader who is spending most of their day focusing on the markets. Remember that there is a big middle ground from people that are, active but not that active, people who are passive but a little more deliberate. And then there are some places in the middle where you're just being thoughtful and intentional about what your goals are and making sure that you're aligning with those. What I would encourage you to think about, if you describe yourself as a boglehead, you've got some longer term horizon, which means you've got room to absorb some risk, but the opportunity to make better gains. I would be looking more at long-term momentum strategies. If you go to my website, marketmisbehavior.com, go to the reading list, I will scroll down to this section right here. I would pick up these 3 books. You're welcome to do it through my website because those are affiliate links and that would be awesome. But these are the 3 books I would encourage you to check out and why. Dual Momentum Investing is by Gary Antonacci. I've met him and interviewed him for my podcast. He's a really smart guy who has spent a career doing long-term momentum strategies. The second book is Quantitative Momentum by Wes Gray and Jack Vogel. I've met both of them as well. Wes gave a great presentation years ago at a conference I was at about the challenges of momentum investing, but why it can be very helpful. And those guys really did a great academic work on quantitative methods to measure momentum statistically and the challenges, but a way that you can structure a good approach. Greg Morris is one of my mentors. His book, Investing with the Trend, is really more of a model-based approach to analyzing market conditions. My own personal portfolio, the bulk of my assets, I've created my own model inspired by the three of these books and some other random ones to construct my own momentum approach. So momentum investing, right? Long-term, like particularly like what Gary Antonacci talks about, it's kind of doing what you're doing with the Bogle methodology, but instead of just blindly putting your money in the S&P or putting it in 60% stocks and 40% bonds, it's a regular process of just saying, what are the strongest assets? Good, I'm going to put my capital there. The next month, what are the strongest assets? If they're the same, I don't touch it. If it's changed and something else has started to do better, I'm going to rotate there. If one of the things I'm holding has started to struggle, let me go to the thing that is starting to do better. And these practices are based on momentum, price momentum. They're based on relative strength. They all have some component of assessing one stock or ETF versus others. And I'm a huge fan. And if you look at all of these books have data to show if you apply these strategies, here's how your returns will be, how they have been, I should say, based on historical data. Here's how it, manages the risk. Here's how it manages the potential returns. I think those are great places to learn more about maybe a hybrid. It's an active passive. It's still passive in that you're not deciding randomly what stock you want to own, but it's a little more thoughtful, because the problem with just diversifying is you're diversifying by definition into something that's probably not that good sometimes. And these approaches basically are diversifying into things that are showing strength. That's how I would answer your question. All right, we'll continue on with a couple more questions here in a moment, but I do want to take a moment and thank our friends at Koyfin. You can find more information about their platform at marketmisbehavior.com/Koyfin, Koyfin, or scan the QR code that you see on your screen. I have a number of platforms that I use every single trading day. Koyfin is one of those. I've met Rob, the guy who designed this product and continues to run the company. He's fantastic and has really done a lot to take some of the best features of institutional platforms like Bloomberg and FactSet and wrap them into a relatively low-cost option for individual investors and especially for financial advisors. And those of you that are watching that are advisors, you work at your wealth manager, you work at an RIA, something like that, Koyfin has some really good features optimized for advisors. Things like model portfolios, things like creating visualizations to help you, have a good conversation with your clients, enrich that relationship, and help them understand how you're positioned and why, and how their portfolios might be doing. You can link to different portfolio management and brokerage platforms and access the holdings directly through Koyfin. Great reports that are built in. If you're an individual investor, I use it all the time for ETF holdings, for attribution reports, which just tells you in a group of stocks where the returns have come from. Really good for understanding sector construction and group dynamics and which stocks are doing well. It's a fantastic tool for that, and I use it every day. You can find more info at marketmisbehavior.com/Koyfin. If you use my link, you get a little better deal than you would if you go right to their website, and it helps me make Market Misbehavior awesome. So thanks for checking them out, everybody. Next question. Have you changed your mind on ENPH? That's Enphase Energy, now that it broke the 200-day moving average. Let's take a look, shall we? ENP. I haven't talked about this stock in a little while, and when you look at the chart, you'll see why. I mean, this is not my go-to chart. If you look at a weekly chart, I remember talking about Enphase Energy a lot, sort of in the COVID era, right, when it was ripping to the upside and outperforming. If we look at the daily chart, the problem with Enphase, it's just been in a downtrend for a number of years now. You look at what happened through most of 2025. We spent the entire year below the 200-day moving average. That's a big no-no for me. We spent almost the entire year below the 50-day moving average, which is also a problem for me. The RSI spent the entire 2025 below 60, most of the time below 50. So all the signs are in a consistent downtrend, or what I'd call a distribution phase, with weaker price action, downward sloping moving averages, weaker momentum. Everything that I just said has now changed. So from October of 25 to February of 26, everything that I just said has changed. We went from being below the 200-day moving average to finally above it. The moving averages had been sloping downwards. Now they're all sloping upwards. The momentum was negative with the RSI below 60. Now the momentum is bullish. Since mid-December, it's been above 50 that entire time. So I like the chart of Enphase, not just because it broke above the 200-day, although that's definitely a big part of it. It's all those other things as well. It's above the 200-day moving average. We're having pullbacks to an ascending 21-day EMA. That's an encouraging sign. The momentum is strong. As long as we keep holding the 21-day EMA, as long as the RSI holds above 50, I think that's a great chart getting greater. So this is a perfect example of why I'm super happy to avoid stocks when they remain below downward sloping moving averages, and why I am intrigued to revisit charts when they reverse and they go above there. And, you know, the chart of Enphase reminds me of like ConAgra and Comcast and a bunch of other stocks that I was ignoring completely for almost the entirety of 2025, just because they were bad charts, right? They were in downtrends. And now all of those charts are above their 200-day moving averages, and the moving averages are sloping upwards. So yeah, I've definitely changed my mind, or changed my outlook on Enphase, because of all of those improved price and momentum characteristics that I just shared with you. Next question. Could you show a demo of the dual y-axis graph? Please make sure to show chart settings. You could use the S&P and the 10-year yield as two symbols. I'm happy to do it. So as you can see, I use stock charts as my primary charting tool. I'm a student pilot. If you've ever flown airplanes, you know the concept of redundancy. And if you don't know what that is having multiple systems that do the exact same thing. What you learn, like, you wonder why airplanes don't have more mechanical issues that come, right? Most airplane crashes, and they're all unfortunate, but most of them happen not because of some mechanical issue with the plane, right? It's not because like the wing fell off or something. It's human error, right? It's bad decision making. And that's why I've looked a lot and thought a lot about the lessons you learn as a student pilot and how that can help you make better investment decisions. Because, you know, we're all trying to make decisions without emotions and based on evidence. And it's tough to do in the air, and it's tough to do with your portfolio. But one thing you learn, the reason why you don't have a lot of mechanical issues, because you have redundancy. When something does go wrong, when a system doesn't work, you have a backup. You have multiple batteries. So if one battery goes out, you can switch to the other one. And in your pre-flight, just on a Cessna, you check and you literally boot everything up and down using the different systems. So if one, just in case one wouldn't work, you can immediately go to the backup system and it works. So there's a whole bunch of redundant systems. So there are different systems that do the same thing. Just in case something unimaginable happens, you have a backup. And the chances of both redundant systems both failing at the same time, the chances of that happening are so low. It's a non-issue, right? I mean, just having those redundant systems is good enough. I think the same thing with charting, right? Stock charts is an awesome platform. Sometime for some random moment, it might not work or it might not look right. And that's why I have some other platforms too. I found it to be very stable. I found it to be very enjoyable. Huge fan of the platform. I have a couple other platforms. So if something would happen, I can immediately switch to a different platform and keep charting. And the website being down for whatever random technology issue happens, I'm available. So the reason why I just went through that whole diatribe is saying, you know, other platforms that I mentioned, the reason why I think it's great to have a couple platforms, they're relatively low cost, the ones that I use. And I think having a couple different platforms that do similar things is a really good idea for investors, just for stability and peace of mind. So I'm going to show you how I do that on stock charts, because it's the main system that I use. But most good charting platforms have the ability to show multiple securities on one page. So how do I do this? You had suggested, and I welcome your suggestion, the S&P. So I'm going to do that. I'm going to do just kind of a basic chart. So here's the S&P 500. You can see the axis is on the right. And you were saying, how do I do a multiple y-axis? So on stock charts, there's an indicator called price. And that's that. And so you need to know the ticker for the other one. You had said like 10-year treasury yield. And then what you do on stock charts is here, it's going to default to making it a panel at the bottom. but we want to overlay them together. So I want to say behind price. It'll look like this. You know, and so stock charts by default adds an axis on the other side. And that's how it does it. All I would say is when you start putting charts on top of one another, I would be thoughtful about things like colors, just to make them easier to see. You know, a lot of times it can be very confusing. What I don't like to do is, you know, mess around with something. I'm like, wait, hold on. What is this blue line? So, you know, just using colors and shapes thoughtfully and axes. Stock charts does not have the ability to have you like stack axes on other sides, but other platforms I've used like Optima give you a lot more flexibility in how you set something like this up. I usually don't do this kind of visual too often because I find this to be a little more spaghetti than I like. It can be very confusing. I like charts that make things simple and accessible. I don't like charts that put the pressure on the viewer to figure out what exactly the hell is going on the chart. So, so I don't use this particular chart style often. This is how you do it. You can also overlay behind an indicator, which would like show the data series below a different indicator for some reason if you'd want to do it. But that's the easy way to do it. Use the indicator called price, put in the other ticker, and you can use things like other arguments like log scaling and other stuff if you want on there. And then it's going to show you on the same table. That's it. Next question. Someone mentioned on X that Microsoft Fibonacci analysis says it can go down to 335. That bad? When to start nibbling? Let's take a look. Microsoft, MSFT. We're looking at my default chart. So I don't know who someone is. You didn't share the tweet. So I don't know exactly what they were looking at, but what would this be? I'm going to guess. So I'm looking at the weekly chart of Microsoft. Here's my guess. My guess what they would be doing if they're using Fibonacci analysis is a major low in October of 2022 and a pretty good double top here. So I'm guessing what they're doing is looking at this and saying that's the low, that's the high. Yeah, that looks about right. You'd said 335. I'm coming in at 339. If I take the October 22 low and the all-time high in summer of 2025, I don't know if that's exactly what they were doing, but that's pretty close. So, you know, yeah, I mean, is that a reasonable expectation of a downside objective for Microsoft? Yeah. And what you're doing with Fibonacci retracements in this scenario is exactly what they're intended for, right? The idea with Fibonacci retracements is they should be able to be used on different time frames. So on my daily chart of Microsoft, I have Fibonacci retracements, just trying to identify some of these short-term support levels between the extremes. Here, we're actually looking at, you know, a longer term. We've broken all of those short-term levels. We're below the 200-day by far. We're now below the 150-week moving average for the first time since early 2023. Seems like an opportune time to look at some really long-term Fibonacci levels. Now, what intrigues me about their level is that it also is a bit of a pivot point, right? And a pivot point is a level where multiple support and resistance levels all kind of coalesce around the same place, right? So here around 335 to 340, 345 or so, this actually goes back to the 2021 low from high from November of 2021. That also lines up pretty well with these summer 23 peaks. That also lines up with the major low in March. So this is a pivot point, right? A pivot point is a horizontal level that has just been tested a number of times, right? The chart of Microsoft is telling you this is an important level. So the fact that Fibonacci retracements kind of come in all around that point as well, I think that is a reasonable downside expectation given further weakness in the chart of Microsoft. What would give me conviction that that level is we get down there, that it's forming some sort of meaningful low? This is where things like the weekly MACD or the weekly PPO can be very, very helpful, helping you confirm going into the low, coming out of a low. Is that a buyable moment? Weekly PPO, weekly MACD can be great ways of confirming that. So having not seen the chart you're referring to, I'm guessing they're doing something like this. I'd give it a thumbs up in terms of the an appropriate use of Fibonacci retracements. And I would say what adds more to that is the fact that that level lines up so well with some of these previous points. The only thing I would add, if I'm critiquing their analysis, I haven't seen, so I can't really critique too much, is I tend to think of long-term support levels as more ranges than levels, saying, expecting that Microsoft's going to hit $335 and that's the low. I think that implies a level of precision to these tools that I don't think is reasonable to expect. So I usually draw them as horizontal, as rectangles, like I showed you, like a range, and thinking of the range, because I think that is a reasonable assessment of how price has interacted with a certain sort of level. It's more of a range, not a precise level. Folks, awesome questions as always. I thank you all so much, those of you that had submitted questions, particularly those whose questions I answered today. Without your awesome questions, I don't have as much to talk about here on a Friday mailbag episode, so thanks for that. Please, if any questions have come up this week based on the work that I've done or some of the analysis you've done in your own work, drop a question in the comments section on our YouTube channel. Thanks again for watching the episode. Premium members watching will have your weekly flight plan for you soon. And remember, it's never a bad idea to become a premium member, I would argue. Go to marketmisbehavior.com/premium. Make sure you use the code YouTube when you check out for a special deal on your first 12 months. For Market Misbehavior, I'm Dave Keller. Have a fantastic weekend. And remember, it's always a good time to own good charts. Take care, folks.